Welcome back to Financial Fundamentals, where we break down money concepts in a way that actually makes sense. Today, sit back, listen up, and learn about something that could genuinely change how you handle the unexpected moments life throws at you. By the end of this video, you're going to understand exactly what an emergency fund is, why it matters more than most people realize, and how to figure out the right size for your own situation. Let's get into it. So picture this. You wake up one Tuesday morning, totally normal day, and then your car makes a noise it has never made before. You take it in and the mechanic tells you it needs a repair that costs $1,200. Or maybe your company goes through layoffs and you find out your job is gone. Or you get a medical bill you were not expecting. None of these things are on your calendar. None of them ask permission. They just happen. And when they do, the question becomes the same every single time. Where is the money coming from? That right there is why an emergency fund exists. It is your financial shock absorber. It is the thing that gives you time and options instead of forcing you into a panic decision at the worst possible moment. Without one, a lot of people reach for their credit card, which solves the immediate problem but creates a new one, because now you owe that money back with interest. And credit card interest rates can be brutal, often well above 20% in many cases. That debt can stick around for months or even years. An emergency fund is how you avoid that cycle entirely. Now let me be clear about what an emergency fund actually is, because the definition matters. An emergency fund is money you set aside specifically and only for true emergencies. We are talking about unexpected, necessary, and urgent expenses. Think job loss, essential car repairs, a medical situation, a sudden home repair you cannot put off. But it is not as a fund for vacations, gifts, holiday shopping, or purchases you have been planning for a while. Those things are worth saving for, absolutely, but they get their own category. The emergency fund is sacred. It stays put until something genuinely urgent comes up. All right, so where do you actually keep this money? This is a question people get tripped up on, so let's slow down here. You want your emergency fund in what is called a liquid account. Liquid, that word just means you can get to your money quickly, usually within a day or two, without losing any of its value. A regular savings account works. A money market account, which is basically a savings account that sometimes earns a little more interest, also works. The key is that the money is safe and accessible. You are not putting it in the stock market. You are not locking it up in a certificate of deposit where you pay a penalty to withdraw early. You want it sitting somewhere calm and stable, waiting for you. Now here's a trade-off worth being honest about. Money sitting in a savings account is generally going to earn less than money invested in the stock market over the long run. It may not even fully keep pace with inflation, which is just the gradual rise in prices over time. That feels like a downside, and in one sense it is. But here's the thing. The purpose of an emergency fund is not to grow your wealth. It is to protect you. The trade-off you are making is safety and accessibility in exchange for maximum growth potential. That is not a bad trade. That is a smart one for this specific pile of money. The goal is to have a reliable cushion when life gets messy. Got it? Good. Because now we get to the question everyone wants answered. How much should you actually save? The commonly taught guideline is 3 to 6 months of essential expenses. And let's unpack that, because essential expenses is doing some real work in that sentence. We are not talking about 3 to 6 months of your entire lifestyle, every subscription, every dinner out, every clothing purchase. We are talking about the core stuff you absolutely have to pay to keep your life running. Rent or mortgage, groceries, utilities, transportation costs, insurance premiums, minimum debt payments, the non-negotiables. Now, who should lean toward the higher end of that range, toward 6 months or even beyond? People with variable or irregular income, like freelancers, contractors, or commission-based workers. Single-income households. People who work in industries where layoffs happen more frequently. People with dependents who rely on them financially. If any of that sounds like you, a bigger cushion makes a lot of sense. On the other hand, who might be comfortable with closer to the 3-month end? Dual income households where both partners have stable jobs. People with strong employer-sponsored benefits and a robust safety net. There is no single right answer for everyone. These are benchmarks, starting points for your own thinking, not universal rules carved in stone. And here's something really important for anyone hearing that 3 to 6 month number and feeling overwhelmed. You do not build this fund overnight. You build it gradually. A lot of financial educators suggest starting with what they call a starter fund, a smaller initial goal, something like $500 to $1,000. just to give yourself a buffer before the bigger goal. The idea is to have something in place right away, even if it is modest, so that a small unexpected expense does not automatically become a credit card problem. Then, over time, you grow it. Here's a quick reflective question for you. If you found an extra $200 in your budget this month, what would you do with it? Using the 3 to 6 month guideline, a 3-month emergency fund for this person would be about $9,000. A 6-month fund would be around $18,000. Now suppose this person is starting from zero. They decide to first aim for a starter fund of $1,000. Once they hit that, they shift their focus to building toward the full 3-month goal of $9,000. They figure they can save about $300 a month toward this goal. At that pace, going from $1,000 to $9,000 means saving $8,000 more, which at $300 a month takes a little over 2 years, roughly 2.5 years total to get from zero to a full 3-month cushion. That is not instant, but it is real, and every dollar along the way is making them more protected than they were before. Now imagine that same person loses their job unexpectedly. With $9,000 in a savings account, they can cover their essential expenses for about 3 months while they search for new work, update their resume, go on interviews, and figure out next steps. They are not forced to put groceries on a credit card charging 20% interest. They are not calling family members in a panic. They have time. They have options. That is the whole point. It is a money-saving tool in its own right. Another thing people sometimes wonder is whether they should invest their emergency fund in the stock market to earn more. And while that desire totally makes sense, here is the problem. Markets go up and down, sometimes sharply. If the market drops 30% right when you lose your job and need that money, you have just lost 30% of your safety cushion at the worst possible time. The whole purpose of an emergency fund is reliability. You need to know it will be there in full whenever you need it. That is why it stays in a low-risk liquid account. One last thing to keep in mind. If you ever do need to use your emergency fund, and that is exactly what it is there for, treat rebuilding it as a priority once things stabilize. Think of it like a fire extinguisher. After you use it, you refill it so it is ready for next time. Here is your one big takeaway from today. An emergency fund is not a luxury. It is the financial foundation that makes everything else in your money life more stable. It is what keeps a bad week from turning into a bad year. Start where you are, even if that means a $500 goal right now, and build from there. That is what we are all about here at Financial Fundamentals, taking the concepts that feel complicated or intimidating and walking through them together, step by step, until they actually make sense. If this video helped you, please give it a like. It genuinely helps other people find this content. And if you know someone who is just starting to think about their finances, share this video with them. It might be exactly what they need to hear right now. Drop a comment below with any questions you have, or let us know what money topic you want us to cover next. We review those comments and we take those requests seriously. And if you have not subscribed yet, please do. There is a lot more where this came from.